As of the last check, the metals company, trading under the ticker TMC, is experiencing a significant surge, currently priced at $9.28, which is a remarkable 20.21% increase on the day. Now, seeing a move like that, many investors, using platforms like Robinhood or SoFi Invest, might be tempted to jump in, assuming they've just stumbled upon the next big thing in the EV and battery supply chain. The expectation is clear. Here is a company poised to supply the foundational materials for our green future. But the reality of what's driving this stock and the immense chasms it must cross to reach profitability tells a far more complex and perilous story. This isn't a straightforward growth narrative like you might see with an established tech giant. This is high-stakes exploration, and the risks are as deep as the ocean floor they plan to mine. The common belief surrounding TMC is that it's sitting on a proverbial gold mine of polymetallic nodules, small potato-sized rocks rich in nickel, cobalt, copper, and manganese, all critical components for electric vehicle batteries. With the global push towards electrification, the demand for these metals is expected to skyrocket. This narrative paints TMC as a key future supplier, an alternative to the often geopolitically complicated and environmentally damaging land-based mines. You see headlines about government partnerships and hit a 52-week high, and the assumption is that commercial production is just around the corner. Investors see the potential for massive returns, thinking this could be a ground floor opportunity similar to getting into Tesla stock or Nvidia stock in their early days. It's a compelling story, and it's one that has fueled incredible volatility and moments of intense speculative buying. However, this optimistic outlook conveniently glosses over the monumental operational, financial, and regulatory hurdles that stand in the company's way. Let's challenge that narrative. The reality is that the metals company is, for all intents and purposes, a pre-revenue exploration firm. It has no significant income and is burning through cash. The recent second quarter financial report highlighted a GAAP net loss of $74.3 million. While some of this was attributable to non-cash warrant charges, the operating loss still widened to $22 million. This is a company that is entirely dependent on raising capital from investors to fund its ambitious plans. While they have been successful in securing significant investments, including a strategic stake from Korea Zinc, their long-term viability hinges on their ability to actually extract and process these deep-sea nodules at a commercial scale, something that has never been done before. The technology is largely unproven in a full-scale commercial operation. The recent stock surge isn't tied to any fundamental shift in their revenue-generating capabilities, but rather to speculative optimism, regulatory progress, and the broader market's hunger for exposure to the green energy transition. This isn't a stock for those looking for the stability of Fidelity mutual funds. It's a high-risk, high-reward play that many retail investors may not fully appreciate. Managing such a position requires a sophisticated platform, something you'd find with Interactive Brokers, which offers tools for experienced traders to handle this kind of volatility. Looking at the recent stock movement, the surge to a 52-week high is accompanied with unusual trading volume, suggesting a high degree of speculative interest. This isn't just long-term institutional investors building a position. It's a mix of retail excitement and likely algorithmic trading capitalizing on the momentum. The stock's RSI is in overbought territory, which often signals a potential pullback. However, in a story-driven stock like TMC, technical indicators can sometimes take a back seat to news flow. The recent positive developments regarding compliance from the National Oceanic and Atmospheric Administration have been a significant catalyst. This news provides a tangible step forward in the de-risking process, giving investors a glimmer of a clearer path to commercialization. It's these incremental regulatory wins that are acting as the primary drivers of the stock price, not earnings or sales figures, because there are none. The institutional ownership, while present, is still relatively low for a company of its market capitalization, with a significant portion of the shares held by the general public. This retail dominance contributes to the stock's pronounced swings. So what exactly does the metals company do? Founded in 2011, this Canadian company has secured exploration rights to several zones in the Clarion-Clipperton Zone of the Pacific Ocean. Their business model is centered on deploying advanced robotics to collect polymetallic nodules from the seabed. These nodules are then transported to the surface and processed to extract the valuable metals within. The company argues that this method has a significantly smaller environmental footprint, with less deforestation, less toxic waste, and a lower carbon footprint. They have formed strategic partnerships with companies like Allseas for the offshore collection systems and PAMCO for onshore processing. Past reports have highlighted successful pilot programs demonstrating the technical feasibility of both collecting the nodules and processing them. The company has also secured sponsorship agreements with the island nations of Nauru and Tonga, which are crucial for their social license to operate and their standing with the International Seabed Authority. The ISA is the international body that governs all mining-related activities in international waters, and its yet-to-be-finalized mining code is a critical piece of the puzzle. The delay in its adoption is a major overhang for the entire industry. Now, let's look to the future. The outlook for the metals company is a study of contrasts. On one hand, the potential upside is immense. If they can successfully navigate the regulatory labyrinth, prove their technology at scale, and secure offtake agreements for their metals, the company's valuation could be a fraction of what it might one day become. The demand for the metals they plan to extract is undeniable. The U.S. government's increasing focus on securing domestic supply chains for critical minerals could also provide a significant tailwind, potentially leading to grants, loans, or other forms of support. The recent compliance from NOAA is a strong indication that the U.S. is becoming more receptive to the idea of deep-sea mining as a strategic imperative. For those looking for aggressive growth opportunities, a platform like SoFi Active Investing might be the vehicle of choice for a stock like this. On the other hand, the risks are equally substantial. The environmental concerns are not trivial. The deep-sea ecosystem is fragile and not fully understood, and there is significant opposition from environmental groups who fear irreversible damage. This public and political pressure could lead to stringent regulations or even outright bans. The company's financial situation also remains precarious. They will need to raise substantial additional capital to fund the transition to commercial production, which could lead to further dilution for existing shareholders. And finally, there is the ever-present operational risk. The deep sea is an unforgiving environment, and any number of technical challenges could arise. Comment below with your thoughts. Do you believe the U.S. government will ultimately fast-track domestic deep-sea mining projects for national security reasons? In conclusion, the current excitement surrounding the metals company is a classic case of expectation versus reality. The expectation is that TMC is on the cusp of becoming a key player in the global energy transition, a futuristic mining company set to unlock vast underwater resources. This narrative is fueled by positive regulatory news and the undeniable macro trend of electrification. The reality, however, is that TMC is a highly speculative pre-revenue company facing a multitude of significant hurdles. The path to profitability is long and fraught with uncertainty. While the potential reward is substantial, the risk of failure is equally real. This is not an investment for the faint of heart or for those who haven't done their homework. It's a bet on a yet-to-be-proven industry and a company that is still in its nascent stages. The recent price surge is a reflection of optimism, but sustained long-term value will only be created through tangible operational and financial progress. This is a story that requires careful monitoring, and investors would be wise to look beyond the exciting headlines and scrutinize the underlying fundamentals. This is not the kind of stock you would find in a diversified, professionally managed portfolio like Schwab Intelligent Portfolios or a traditional Fidelity wealth management account for a reason. It is the epitome of a high-risk venture, where the potential for both spectacular success and complete failure exists in equal measure. The content shared here is for educational purposes only and should not be considered financial advice. Always consult with a qualified financial advisor before making any investment decisions. If you found this helpful, please like, comment, and share to support the community.